we want to go to the most important event of the week, or the most important thing of the week, and we always invite a guest to join us. And so for this week, we invited Alastair Williamson to join us from Stockboard Asset. How you doing, Alastair?
Doing well. Thank you guys for having me.
Now,
And it's yeah,
yeah, Alastair, you also have a drink in hand. What are you drinking today?
I do. I have a Jose Cuervo, couple shots, watered down. After I pull about a 15-hour rotation every single day, and this week's been very chaotic. I usually don't try to drink on the weekdays, but it's Friday, and I have to have a beer for or a drink for you guys as well.
All right, fantastic.
That's right.
Well,
Yeah.
listen. Let's jump right to it. Between drinking, we're gonna turn around and bring up some of the things that you wanted to share with us. So, you prepared a slide deck, and it's all under one major theme. So, while I get that set up here on the screen, why don't you give all of our listeners a good rundown of what your bigger picture central theme is, and what you're gonna talk about with us?
Of course. Well, I just want to say thanks again for having me on. And the central theme is we're trying to debunk the second half growth narrative that has led to this incredible multiple expansion that we've seen in the past 4 to 5 months. And we're looking for signs, hints, and clues of if the second half is going to actually have this rebound and markets will continue higher. And what I'm coming up and developing today is that that might not be the case. I created this slide deck, which are most relevant charts that I have had on Twitter for the past 48 to 72 hours, because I think we've had a very large sentiment shift in the last week. But what we can do is we could start with the first chart here, and this is an expanding megaphone, and we're looking at the ES. So this is the S&P 500 E-mini contracts. These are continuated. So we come to this threshold here, this level of a three peak, and I believe it's three peak. And the reason I have Trump, and when we look at where the markets are and what the administration, from Kudlow to Mnuchin to even Trump, have said over the last couple of weeks of QE4, 100 basis point cuts, the Fed responded and said, we're not going to do that at these levels, or we're not going to do that at this point in the economy. I think where the markets are going to go they're going to go much lower, and that's going to be spurred by the administration. And how is that going to be spurred by the administration? Exactly what we saw Friday morning at 12:01, an increase of the tariff rate of $200 or so billion. We went from, I believe, 10 or 12% to 25%, and that's going to have negative effects on the U.S. consumer in the second half, and that's going to have negative effects on EPS growth for the S&P, and we're most likely going to see probably analysts cutting their targets in the coming months because of this deepening of the trade war.
So, Alistair, I have to ask you, like, I mean, this is a very contrary view because almost everyone that I hear talk about Trump, they're actually taking the angle where he's going to defend the stock market because it's a vote of confidence on his ability to driving growth and prosperity, and that this is almost like a completely contrary view, which is that the weakening the stock market is going to lead to the stimulus that he wants. I find that fascinating that you're taking that angle.
So look at what I mean, his tweets are out there. It's interesting to follow along. And, he was complaining that President Xi was getting all this stimulus, and he wasn't. And I think the administration knew exactly what they were doing with the deepening of this trade war. And there's one purpose and one purpose only. President Trump needs rate cuts. He needs QE. And that is what's going to float this economy to 2020. And as he said, if rates drop, the economy will skyrocket or
Right.
something on those lines.
So on your next chart here, you were overlaying the industrial metals here. What are you seeing with the break evens?
So I think what we're having. So let's go back to a very relevant point of Q116. As we all know, the world was in a lull of growth, so it was slowing, and what was meant by global central banks from the BOJ, ECB, PBOC, SNB, we can go down the list, was a massive expansion of their balance sheets. We saw synchronized growth. We saw commodities to the upside, inflation to the upside. And then we get to this point of about Q1 18, and that's when the global economy started to roll over. Now we're getting to the point where where I believe quantitative easing or any type of intervention, if that is fiscal, is going to have a diminishing effect on the global economy. And this slowdown is going to, I think, we're going to see a downside. We're going to go into a more of a deflationary period, and we're going to see copper, steel, rebar, anything that's in that industrial metals index move lower to the downside. I think the central theme here is the intervention that we see of global central banks. I just don't think that they have enough power this time around. I mean, it's clearly evident, I think, with what's happening with China and their massive stimulus in January. You see their markets or their economy somewhat shored up, but it's not this synchronized growth view that everybody has, and they're thinking that 2016 all over again. We don't see it in Europe. We don't see it in these, I call these peripheral countries around China, which would be Singapore, South Korea, Japan, and so forth. We don't see the growth ticking up yet. And now is the time, if you believe in the second half narrative of all this wonderful growth, now is the time that you would want to see global PMIs and other trade data starting to perk up, and that is not the case yet.
Right, right. That makes sense right there. And what are you seeing here in the Kospi?
So I see probably a 2016 low retouch or a tag double bottom. Just you see this large diagonal demand line, this ascending demand line. What we would call that in the technical analysis world is a top bump and run formation. It's a perfect formation. I mean, these linear moves always tend to break, but I think the weakest countries go first, and specifically, South Korea is a major exporter of electronics around the world to China, so forth. There's some very interesting data that came out with the with semiconductor exports of South Korea to China, just year over year, I think down 20%. So if we want to look for signs that possibly the second half narrative is the second half narrative of all this wonderful growth, if we could debunk it, maybe it's looking at the rest of the world, specifically the Kospi and South Korea.
Well, Alistair, I couldn't agree more. But I look at the Kospi, and it actually it was a potential candidate for jumping onto our top five things to watch with this
Mm.
breakdown. And one of the reasons, though, I watch it is I kind of look at it in its correlation to the whole emerging market space. Because in my mind, while everyone loves to look at U.S. data points, to me, the real global economic slowdown is happening from global dollar shortages, and it therefore is impacting many of these emerging market countries the greatest. And so,
Let me give you.
sorry,
Oh,
go on.
sorry. Let me give an example. I was just recently in Argentina. There's a few traders I know down there, and they took me around the country. We toured Buenos Aires, Palermo, and very interesting. What they told me is that less than 10% of the population actually owns investments in stocks
Right.
or just the stock market. And what they said is that the people down here are demanding two things. And by the way, it was in a recession, so this was February March timeframe. I was in there. They're in a recession. The economy's rolling over. They have issues with the ARS USD, which is the Argentinian
Yeah.
peso. It was paid, I think it was like 39 to 41 to the dollar.
Here, I'll
And they
I'll,
told
I'll
me,
pull it up because this is
yeah,
like a totally a worthwhile story. Like you can see, the
the,
currency's
the,
just been hammered.
oh, 50%,
Oh yeah.
from last year to the downside. I mean, it's incredible. And then, the IMF bails them out with the reserves. That doesn't work. But, what they tell me? They say, Alistair, there's two things that Argentinian people who are in the know, what they're buying. This is what they're buying as an investment: the dollar and Bitcoin. And I said, wow. And he said,
Wow.
yes, we all hold dollars. And, which I think would, excuse me, play into the theme of this dollar shortages as EM currencies around the world. I mean, just look at the lira, is collapsing again. I think countries and the citizens within those countries that have weak currency, heavy debt loads, U.S. dollar denominated debt loads, I think they're reaching for dollar, and I think that's exactly why I don't have this on the slide, but I think the dollar is going to go much higher and well into the 101, 103 level.
I couldn't agree more. So I'm not going to object.
but so I, I
But
haven't jumped in. I haven't jumped into the precious metals game yet. That's not yet. I think the dollar has to have this blow off, and we're going to
so
have to see more of a crisis.
So, Alistair,
Probably.
just so you know, the reason why Kevin has not pined in here at any moment is because he completely disagrees with me and you, and
No,
he doesn't want to
no,
be rude. He doesn't want to be
no.
rude to and
It's not that. I actually, Alistair, was going to interrupt and say that the fact that both Patrick, myself, and you think the dollar is going higher is probably like whenever Patrick and I agree, I was going to give you a big sort of heads up that you should be careful because we all think the dollar is going higher. So, but listen, I'm always open to new ideas. So let's let
oh
Alistair
yeah,
keep
yeah, for
going there.
sure. Okay, so anyway, Alistair, I have here up your chart on the JPN topics. So what are you seeing here?
So I think again, you could overlay this similar pattern of this downside continuation, like I said, with the Kospi possibly retesting the Christmas low. Is that we're going to most likely see that in Japan. I think if we wanted to understand if Asian equities as a whole would go to the upside, we would need to see trade data support that with China. I don't think we have that yet, and most likely that's why we see a downside continuation with the Japanese topics.
Right, right. And so now over here, the next chart you have is the MSCI US low vol
So
index.
so I'll explain that. That's a great index. And what the top 10 constituents of that would be like Visa, Waste Management, McDonald, like your big blue chips, PepsiCo, Coca-Cola, so forth. And what we see is we see this like Q4 17 into Q1 18, this linear move up. I mean, I think that's just the hurting of the market, racing for yield, nothing else left. As the FOMO. I mean, we all know the narratives of
Yeah.
what has happened, and you get this linear move up, and then it breaks, and then you have a vol blow up, and that's exactly what happened in Q1 18. And then we see that in from Q2 18 to Q3 18. Of course, we know what happened. Around October 8th, 2018
So
is a rollover, and then we are where we are today, which I think is that this chase for yield has put so many people on the wrong side of the market, and when that second half growth narrative gets debunked, many people are not hedged for the downside, and obviously we can see that in this chart.
All right. So moving on here, you get into the corporates. What's on your mind here?
So specifically, I'm looking at the CDX NAIG. It's a credit default swap. So it's basically like insurance for credit of major U.S. companies. And what we see is we're starting to see a tick up in credit, and that's being spurred by equity vol. And anytime we see that, we would have a warning as far as sentiment and sentiment shifting. For us to actually buy back into the market, which, by the way, let me just say that we sold a major book in March to raise cash, and primarily, the way I'm positioned is pretty much the highest percentage of cash in this entire cycle, with a short in semiconductors. But what we would want to see to come back into the market is we want to see these credit default swaps instead of widening come back in, and I think we're going to come into a new regime here of credit default swaps.
Isn't it amazing though, Alistair, that like here I'm pulling up the chart. This is your actual credit spread over Treasury on the
Yeah,
corpse, and we haven't seen that uptick here, right? So like if you this is a 20-year chart, but let me just quickly go to a 1 year. But like you can see, ever since that bottom in December, the credit spread just completely collapses from over 200 basis points to down to 150, pretty much right back to consolidation levels where we were back in
yeah.
2017 and 18. And so when I look at this chart, to me, I don't see the corporate bond market at the investment grade level getting nervous yet. But you're showing here that that at least on this derivative, they're starting to price some of that
What,
fear in, right?
one second, Patrick. Can I
Yeah.
jump in there? It's Kevin. It's because Alistair's chart only goes back to February. So if you actually looked at that and compared it to your chart and did it only from February to May, it would look very similar.
Oh,
So
gotcha.
my
Yeah.
time frame is,
Yeah.
so like what I'm trying to do with this time frame is time this cycle here. We had this Christmas low in the S&P, low 2300s to 2940. What I'm looking for today are signs of stress, and obviously I would want to look at it a smaller time frame to get this turning point, which it would make sense that credit is an issue again, and why we see the S&P into the
So,
2800.
do you think that this is a short on corporate investment grade bonds here?
That's something that I don't trade, so I wouldn't know too much in.
But this worries you about the
Of
byproduct, which is
course,
on the
yes,
equity markets, right?
yes,
I know,
yeah. So
Kev,
it's
what do you think?
so it's
Are
one of
you in that position?
Um, I'm not sure what I feel right now about credit. I'm probably not as concerned about it as most of the hedgies are. I think that, as you know, I'm not as bearish as most. But let's let
Yeah, yeah,
Alistair go on
for
with the
sure.
next one there, Patrick.
All right. So, Alistair, what's on your mind here on this S&P leverage loan index chart?
So this is an index of leverage loan prices, and we're looking to see when this will have a cycle peak and then reverse, and then it would give us a better indication of that the equity market has rolled. Leverage loans are used to finance heavily indebted companies, and those would be some of the first signs of stress that we want to see. We're starting to see a little bit of resistance hitting, but nothing too serious yet. I think for equity markets to go into the 2,700 handle, we would need to see a further confirmation on the S&P leverage loan index here. One of the ideas of in Christmas, 2 or 3 days, excuse me, before Christmas, uh, I was getting out of my shorts from September, and that was a 2 3 month play there, and going into long. And one of the things I was watching was the credit market and leverage loan index, and it served its point to help me find the turning point. And I think looking at investment grade credit default swaps, if they're widening, and looking at this index, if it's reversing, would give us just more indications that the equity markets are peaking.
Right.
Hey, can I jump in there? It's Kevin. So actually, just can you talk to me a little bit about how you used the your leverage loans in terms of December to signal the bottom? Because to me,
So
it felt like a little bit. Just one second, because it felt like a little bit like it felt to me like loans were kind of lagging the market. And maybe I was wrong, and maybe I'm looking at it differently. So I'm curious to hear about how you used it in December.
So do you see right before the bottom, there was an attempted bottom, maybe a few days before January. So
Okay.
I had various indicators that were showing that a bottom was nearing, not necessarily that it was at a specific date, but it was showing. So for example, single banded and double banded oscillators that I had, it was showing that a divergence was occurring and a bottom would be nearing, not necessarily on a specific date. And it worked out. But
So
obviously, it
so
worked.
you were so you were looking at technical indicators of the leverage loan market to
Of course,
indicate
yes,
like a
yes,
oversold condition,
yes,
and then you
yeah,
used that as the trigger to go long stocks.
yeah. So it was leverage
Okay.
loans, credit. So when credit would subside, then you would know that it's risk on, and that's kind of what happened. But we all know why we had that reversal in credit default swaps. So they were coming back in, and the leverage loan index spiked higher is because of government. It was because of central bank. It was intervention.
Right.
And this intervention, I think, is unprecedented to degrees that I have certainly not seen, and individuals who've been in the industry much longer than I have not seen. And it leaves me to an indication that what we've seen from Christmas low to today is not sustainable.
Right. Right.
I mean, it could go on much longer than I anticipate or anybody else anticipate. So be it. But the idea of this linear move in markets is not sustainable. Look at the equity markets today. An individual told me that these trends start on news and they end on news. What was the
Yeah.
news? What was in the news around Christmas? It was the trade talks and plunge protection team and all this nonsense. And then, what's the news today? The news is we're going to hike the tariff rate.
Right. Well, you know what? If you think about it, what are we off the lows? Like 10-15%. I don't know what the number is, but you annualize that and you realize that
Yeah.
it can't. We would be, the S&P would be 10,000 by Christmas if it kept at this rate. So no doubt about it, we're due for a pause.
Yeah, and I think that's what we're seeing here today. But this is
But
actually great. This is a great chart. I don't have this one overlay, but I'm going to tell you guys what it is. It's the money base. It's the U.S. money base. I guess this U.S. Federal Reserve balance sheet. And if you overlay that with that chart, what happens is that when world trade volume reverses, the Fed is there with liquidity. And what we see today, coming off that high, I believe, I can't see exactly where that is, but I would say 1Q18 is probably the level of where world trade started to peak, maybe the second half, probably when the tariffs started to come online. But what it shows me today is that we have a serious issue with the global economy, one that is a synchronized slowdown. And I believe the interventionists do not have the correct tools in play that can create the softest of landing of what the equity markets are pricing in today, or
okay,
have
that's an interesting.
priced in.
One
Yeah.
second, that's an interesting concept. When you say the interventionists don't have the tools, what do you mean by that?
Well, the interest rates, the quantitative easing,
So you're
the
saying that they can't the Fed's like hamstrung in terms of they don't have the political kind of ability to do that, or you're saying they don't have the will to do it, or
so
that
so so
the
political.
interest rates aren't going to matter.
So I think political wise, that would be pretty hard to do. Obviously, the Trump administration is trying to move that through, but you see this inequality that's happening, throughout the country in major cities, and one of the major reasons why the Trump administration got elected was a lot of his base was the forgotten Americans who were disadvantaged, or were they had the financialization of the economy, the wealth inequality. They're the ones who, some of them didn't own assets, and people got really mad. And I think the political will, I think their constituents would be like, senators and congressmen. I think it would be pretty hard to convince the American people that we're going to do more of the same is what got Trump elected. And I don't think that can happen. And what caught my eye was when the Trump administration was talking about quantitative easing again. I'm saying this is why he got elected, and it was completely baffling. But sorry.
So
Yeah.
Alistair, so I just want to understand so you're arguing we're going to have a slowdown, and then the tools to prop it back up are no longer going to be effective, and not only that, they're going to be difficult to implement. Is that correct?
Exactly. So I think difficulty to implement would be number one, and number two is the effectiveness. I mean, the tools could still work, but they're just not going to be as effective as before. And I think we're already starting to see that in Europe, specifically the ECB LTR 2.0. Europe's either, Germany's either in a recession or teetering on a recession, and that is a very significant region for manufacturing. And if you look at trade routes, I didn't put this on the chart, but Freightos has good trade route data of containers, pricing of containers, 40-foot containers, and I monitor these container routes. It's updated weekly, and many people use the BADI index and other indexes, which I don't think are as sensitive. You really want to follow from a EM country or DM country, or specifically just EM to DM. You want to follow container ships because that's the type of vessel that will take a raw material into a finished material, and then or finished good into DM. But if you look at the trade routes from Europe to China or China to Europe, you do see depressed rates, and actually depressed rates around the world. So I think trade as a whole is coming into an issue, and what we see with the ECB and their stimulus, it's not working. China, it could be supporting their own internal economy, but it's not supporting countries around China. So I think that's some evidence today as far as stimulus not working to what everybody thinks it will happen, which would be the synchronized growth. And that's why we see a
Okay,
deep.
so
Yeah.
right, so let's just play this out. So we get a second half slowdown to the point where it's unequivocal, and the bulls can no longer kind of pretend that the economy is still going. And at that point, the Fed tries to lower rates, but it doesn't really work, and they can't do enough of it. Do you think that we get a 2008 style kind of collapse in risk assets? Is that what you're kind of where you're headed with this?
Well, I mean, I think there's so many more tools that are in play to prevent that type of major imbalance to the downside. I'm more into the camp that the slowdown is going to be harder to prevent, and I think what's happening today is unprecedented as far as the Trump administration with the tariffs, and full well knowingly what tariffs will do to the global supply chains, these complex supply chains. They're disrupting, and disrupting is multiple things for companies. It's time and money, and things that many companies don't have these days. Heavily indebted. Corporate debt is at record levels. So reworking these supply chains, I think, is a very big issue. But going into the second half, I think the administration deepening the trade war is going to have the Fed in a position in a very tough job. And actually, I think a Fed member came out on Friday today and said that if the trade war deepens, we will meet the U.S. economy with stimulus. I think that was a headline. Bostic, I think, said that today. So it shows me that I think this Trump administration is purposely sending global trade into chaos, as you can see on this world trade volume, so that the administration can get what they want, which is QE4 and rate cuts.
So, Alistair, that's some interesting
But
kind
it
of
may not. But it may not.
thought-provoking ideas.
Yeah, but it may not be
S
effective as before, and
Right,
that's the danger. Is that if these tools, I mean, it's like the Trump administration is controlling this down move because they want to trigger the Fed into stimulus, and why?
right,
Because they need 2020. They need their constituents, their the Midland of America, the Midwest, the Rust Belt. They've been heavily impacted by China and the tit for tat retaliatory tariffs. The soybean farmers. So the administration is going to do anything in their power to clean up the mess that they created. And I think
right.
the only solution to that is easy.
Right. So do you just to sum it all up, do you like a trade of like long the short end, like a levered up long short end kind of on the yield curve position, or do you like the short risk asset trade better?
I don't trade enough bonds to do that, but I would say one of the positions that I have. I like to talk about my positions, obviously, because I have to do the due diligence, so forth, create the charts, whatnot. But I think risk assets, yes, short risk assets, and I think the largest imbalance in the market would be semiconductors. I mean, Intel came out the other day and
Oh yeah.
said that the semiconductor, the that industry is gonna be in a slowdown for 3 years. Now, the whole narrative about semiconductors with management teams across the board, they're all calling for this second half rebound. And I think Texas Instruments management came out and said, in this industry, we can't even see 1 or 2 months ahead. So how is everyone projecting this glorious second half rebound? And I always I'm going back because I think the core theme of this, in my view, of this conversation is trying to figure out and debunk that second growth narrative, that glorious growth that we're supposed to be having, which I think we would want to look to semiconductors. They are a leader in this cycle, well, probably in the last few years. But the leader is telling us that there's going to be serious growth issues. And it's not just here in the US, it's South Korea, it's Japan, it's China, all the other charts that we were just looking at. It's telling us that there is serious
So,
issue.
Alistair, just so you are aware, and I'd like you to kind of give your opinion here. But Kevin and I have a bet from last week's episode on semiconductors, don't we, Kev? And
That's right.
and so we were talking about the fact that whether or not Intel ended the party on the semiconductors, and was it a burger joint bet that we made there?
That's right,
That was a
burger
burger
joint.
joint.
Because we've been betting too
We
many
haven't
steaks.
betting too many steaks, but my bet was well, actually Kevin's bet was that semiconductors will remain in the top 5 best performing assets by the end of May, or at least sector.
Yeah.
Sorry, would you take the over or under on that?
Well, let's just look at what happened this week. Semiconductors were down 6% on the week. I think what's going to happen is a continuation with semiconductors. Maybe the bounce oversold conditions, but I would say to the downside, semiconductors will go. Intel's leading that. It's not. It's
So,
just
are
not. It's
you
not just
betting
U.S.
with me
companies.
or with Kev? Are you gonna
Yeah.
take?
No, he's betting
He's betting with
obvious
me, but
Alice, I mean, he's for sure betting with you. It's his number one short,
I
Patrick.
want
I,
him
I
to
have to.
say it. I want him to say that I'm with Patrick on this. This is what I'm fishing for here. So, Alistair,
So you're fishing. Your fishing's
thank
correct.
you,
I'm
thank
with
you. All right, Kev.
with Patrick. I like I like to
Okay.
talk, I
So
like to talk my book, and the book. It's been challenging. I mean, it's been very challenging to get this short. I mean, sometimes it takes me weeks, if not a month, to get in these positions, and the semiconductor short took me a couple weeks. I mean, especially when Qualcomm came out with their news and launched these. Semiconductor indexes. Yeah, I had to re-leverage and keep going and going and going, and then finally get the turn here. But I think the news is out. Intel spoiled the party, and we're going to see a continuation to the downside. But as we know, I mean, any individual in this industry, moves aren't linear. They're zigzags. So yes, you could have an up week, but the overall move, I believe, is down, and we have that blow off top that Qualcomm created.
Alistair, when I lose my bet, because Patrick's pretty sure I'm going to lose my bet, you're welcome to come and have a burger with us in Toronto anytime.
Of course,
So listen,
is it the Impossible Burger?
the impossible. No, we're not gonna do that. We're gonna a real burger and at a real burger joint and with plenty of beers and no sours. So Alistair, this has been great. For those that want to hear more from Alistair, make sure you stick around for the after hours segment where we get drill down into some more kind of interesting charts. We might talk VIX. We might talk about a bunch of other topics. In the meantime, Alistair, why don't you tell us everyone where they might find more stuff from you, what you do, where they can kind of reach out and talk to you, and all that stuff.
Great. Well, thanks guys for having me over, and I hope I convinced some people that the view that I have is a second half rebound. Trying to debunk that. But where you can find me is Twitter. I think that's the best place. In the financial world, I think Twitter and social media, specifically Twitter, has been one of the best. So I write macro all day, research and so forth, and Twitter is just an extension of what I do, and it's very easy. When I'm writing something, I have a chart, and I just put that out on Twitter. It takes 15 seconds, and I think many people appreciate that. So you can find me on Stockboard Asset on Twitter, and that's primarily the only platform that I am communicating on.
Well, Alistair, yeah,
That's true.
thanks for joining us there because I do follow you on Twitter and you do put out some great stuff. So thanks for joining us. But otherwise, for those of our listeners that want to hear more from Alistair, make sure you stay for the after hours or the after the show segment where we're going to continue our conversation with Alistair. Thank you.